IndusInd Bank, a prominent private sector bank in India, recently disclosed a significant accounting discrepancy, a $175 million gap in its derivatives portfolio. Miscalculations in currency derivatives over 6 years. Investors and regulators are worried. The Reserve Bank of India is investigating. In the wake of the accounting scandal, the RBI requested the resignation of IndusInd Bank's CEO Sumant Kathpalia and his deputy. The CFO also resigned, adding to the shake-up in the bank's top management. Moody's, a leading credit rating agency, placed IndusInd Bank's baseline credit assessment under review for a potential downgrade due to concerns over inadequate internal controls after the lender found discrepancies in its derivative accounts. Despite the concerns, Moody's affirmed IndusInd Bank's long-term deposit ratings with a stable outlook, acknowledging the bank's strong funding and liquidity profile. The RBI's intervention and the credit rating review underscored the importance of regulatory oversight in the banking sector. The incident prompted calls for strengthened regulatory frameworks and enhanced supervision. Experts emphasized the need for proactive measures to prevent similar lapses in the future. The banking industry as a whole faced increased scrutiny. The RBI's decisive action reflected its commitment to upholding governance standards in the banking industry. The news of the accounting discrepancy sent shockwaves through the stock market. IndusInd Bank's shares plummeted over 30% following the disclosure, wiping out a significant portion of the bank's market capitalization. The stock's volatility prompted the National Stock Exchange of India to place IndusInd Bank on its futures and options ban list to curb excessive speculation. However, the RBI's subsequent assurances about the bank's capitalization and liquidity provided some relief to the market. IndusInd Bank raised 110 billion rupees or $1.27 billion through short-term certificates of deposit to shore up liquidity. The bank also engaged PwC to conduct an independent external review of the accounting irregularities and the bank's remedial actions. The RBI confirmed that IndusInd Bank maintained healthy capital adequacy and liquidity ratios. The bank's capital adequacy ratio stood at 16.46%, well above the regulatory requirement. Similarly, its liquidity coverage ratio was at a comfortable 113%. These metrics indicated the bank's resilience and ability to meet its financial obligations. The accounting scandal at IndusInd Bank has raised broader concerns about governance and compliance within the Indian banking sector. The incident has highlighted the need for robust internal controls, effective risk management systems, and a strong ethical culture within financial institutions. The RBI's proactive response, including the requested resignations and the push for an external review, demonstrates its commitment to maintaining the stability and integrity of the banking system. The incident has also reignited the debate about regulatory oversight and the need for enhanced supervision. Some experts argue that the current regulatory framework needs strengthening to prevent similar lapses in the future. They propose stricter penalties for non-compliance and greater transparency in banks' financial reporting. The bank's ability to restore investor confidence, strengthen its internal controls, and address the concerns raised by the RBI and credit rating agencies will be crucial for its future performance. The completion of the external review by PwC and the implementation of its recommendations will be important milestones in this process.